All right, guys, welcome back. Today we're going to be covering the 2022 model, right? And we're going to get a little more in-depth than ICT kind of taught it in his 2022 mentorship. In his mentorship, he was teaching more towards beginners. This is a lecture for if you're more advanced in that, right? If you've been using the 2022 model for a little bit longer, or you can just use this as a supplementary lecture after you finish that 2022 mentorship series. So why does a 2022 model work? Well, this is the low-risk sell of a market maker sell model, or the low-risk buy of a market maker buy model. This is that point after you get a liquidity sweep and a change in the state of delivery where the buy program is changing from a buy program to a sell program, or the sell program is changing from a sell program to a buy program, right? You're essentially catching the beginning of that run in the lowest risk possible. Now I have the daily chart pulled up here on NQ, right? And we're looking at this market maker sell model here on a daily chart. So just a quick recap of a market maker model, right? The context is we were moving in one direction to then move in the other direction. So we can see here we have our July 2022 quarterly shift. Now we're looking at our 20, 40, 60-day look-back period. We're looking for a premium array to retrace into to try to find the top of our market maker model, right? You can see that this is the price leg in question. If we divide it into premium and discount, we can see that we have an equilibrium price point right here with two bearish PD arrays. On top of that, we have buy-side liquidity layered just on top of here. So the context of this market maker sell model is we are retracing to take out buy-side liquidity and to fill in an area of fair value before once again trading lower to and through our initial consolidation. In this context, your 2022 model would be right here. We have a sweep of buy-side liquidity inside of a daily sell-side imbalance, buy-side inefficiency right here. So now step one is complete. We have a narrative and a reason as to why price should be acting the way it's acting. Now, the next thing you want to be looking for after that sweep of liquidity is displacement below the very last stage of reaccumulation. That is what solidifies a market structure shift in a 2022 model. This is pulled straight from ICT's charter content in Model 6 and Model 7, where he gets very in-depth with market maker models and liquidity depth profiles and things of that nature. As we can see right here, we have our final stage of reaccumulation in this box right here. So what we're looking for is a market structure shift coming below that last level of reaccumulation, which we can see we have right here. So we can remove this box, extend this out to the left here, and now we have a valid market structure shift on a closing basis once we're trading through here. Now the fourth thing we're going to be looking for here is just simply a fair value gap, right? We have a fair value gap right here. We can mark that out, extend that to the right. Now we have an area of interest as to where we're going to be taking our entry at. Now, if you're familiar with market maker models, you understand that this is your low risk sell of a market maker sell model, right? Your stop loss would simply be above this high, and your take profit is going to be either at the next level of reaccumulation or at your initial consolidation lows. The best option, if you do not have more than one contract, is always to take that low hanging fruit here at the next reaccumulation low. Now, the highest probability market maker models with a 2022 model entry is going to have this same pattern that you see here. High, low, higher high, market structure shift, right? Displacing below this low right here. This is going to form your ICT bearish breaker. So we can take the range of the lowest down closed candle in this range of down closed candles, extend that all the way out to the right. Now you have your bearish breaker marked out. Now this gives even more context and even more narrative to the situation at hand here. If I take you guys here into market replay mode, I'll tell you exactly what I'm talking about. So we are in an overall sell program here on the daily and weekly chart. We have our quarterly shift starting Q3, going to equilibrium, taking out that liquidity in a premium array here, and we get displacement, a shift in market structure below the last stage of bullish reaccumulation, solidifying that as a valid market structure shift. We have two fair value gaps here. which one are we looking to use? Well, now that we've identified our bearish breaker, we know that price should trade up into the breaker and displace out of it, having a low resistance liquidity run through these candles down to our next area of sell-side liquidity here. Given that context, this SIBI should be treated as a breakaway gap. This is a fair value gap you do not want to see price return to. If we just play this out, we could see we trade up into that breaker, displace out of that breaker and fair value gap, and we continue all the way down with more displacement until we get down to that level of sell side, right? Now that we've taken out this level of sell side, it's reasonable to see a retracement into this SIBI right here. Notice there's no buy side imbalance, sell side inefficiency here. Therefore, it is not a balanced price range. Since it's not a balanced price range, it'd be reasonable to anticipate a return to the sell side imbalance while taking out all of these measures of internal buy side liquidity. This is an area where you can look for a fractal lower time frame market maker model to offer you another 2022 model entry. All right, so now we are all out of market replay mode, and we're going to be going over these targeting options, right? There's more than one option you can target here. I'm going to break down each targeting option, when they should be applied, and why they should be applied, right? Why are they solid targets to shoot for? So now we have our 4 steps as to how to take an entry. So now let's look at our options for taking targets, right? The first one is going to be that low-hanging fruit. Now this is simply the first spot you can possibly take profits. So again, in this scenario, your low-hanging fruit would be right here at the very first measure of sell-side liquidity after taking your entry. You always want to be taking this low-hanging fruit if 1, you're new to this model, or 2, you're trading with only one contract. If you're trading with only one contract, this is a place you want to be taking profits. If you're trading with more than one contract, like I said earlier, this is a perfectly acceptable place to take a partial and trail that stop loss back to break even, secure that profit, and eliminate that open risk. Now, next up, we have equilibrium. Now, if you don't know what equilibrium is, it is simply that 50% price point of a price swing. So I'm going to show you what that looks like here on the chart. We simply take the high of that price swing and the low of that price swing. You look at this 50% mark right here. Might be easier if I divide it into halves so you can see this 50% a little bit better. This is that 50% mark. Now, the reason you would want to be taking profits at equilibrium is because if you are not advanced enough to know whether we are in a bullish reaccumulation profile or a market maker sell model, you do not want to get stopped out of your trade before taking out this low-hanging fruit, because that might not be taken out in the first place, and let me tell you why. When we are in a buy program, equilibrium is then acting as a discount. What that means is any PD arrays at or near equilibrium will act as a discount array to send price higher. It doesn't need to trade back into a discount because it is already in a buy program. So now we're looking at equilibrium. Do we have a PD array at equilibrium? We do. What do we have? We have a buy-side imbalance, sell-side efficiency, a reasonable PD array to anticipate a retracement into, right? So if you're taking this 2022 model, you're not entirely convinced that it's going to be a market maker sell model running all the way down to that initial consolidation. You think it might just be a retracement, a smaller retracement in a higher time frame price swing. Equilibrium is where you want to be taking profit, right? So if you're unsure, take your profit at equilibrium. Now, our third targeting option is to target that market maker terminus, right? That terminus is the price point where the market maker model concludes. That's just going to be the low of the initial consolidation, right? If you're bullish, you're going to be looking for the high of that initial consolidation. So if we take a horizontal line and we delineate where this is right here, we can take this off of the chart. This is going to be our market maker sell model terminus. This is our initial consolidation low, right? I'll center this text here so it's a little bit easier to see. Now, this is the most advanced level to target, right? So this is something you're going to be working for. This is not something you're going to go through and watch this video 1 or 2 times, be able to go on your chart and just start hitting trades from high to low. That's blatantly unrealistic, right? It takes practice. It takes months and years of practice before you can get to this level working with market maker models and the 2022 model, right? Again, if you want to be targeting this and you're not extremely experienced, your goal is to be having 3 contracts. So you can take a contract off at each targeting option. So if you're trading minis and you're over leveraged trading minis, you can move over to micros so you can maintain your standard risk. So you can take 2 partials and still have room open for that final take profit at the low of the market maker model. Now, before we close this up, I'm going to go over our stop loss options here. Where do you want to put your stop loss when you enter the trade? When do you want to trail your stop loss, etc., right? So when you first enter your trade, your first stop loss placement is going to be above the high that was formed, right? So make this a little bit easier to digest and understand, I'm going to head back into market replay mode and throw on a short position here and show you exactly where we should be trailing our stops. So assuming we're taking 3 contracts and we are targeting the very low of this market maker model, right? So if we want to draw this back out, we can have our bearish breaker right here, and we can have our sell side imbalance, buy side inefficiency right here. So step 1, we have a liquidity sweep. We got that. Step 2, we are looking for displacement. We got that. We're looking for our market structure shift, right? Looking at this last stage of bullish reaccumulation before that liquidity sweep. We got that on a closing basis, therefore it is valid. Last step is a fair value gap. We have that identified right here. To make it an even higher probability fair value gap, we have a bearish breaker in alignment with that fair value gap. So once we trade up into that, I'm going to be taking a short on. All right, there we go. So let's sell 3 contracts here. We're going to set our stop loss initially just above the high that was formed, right? This is how I play it safe. If you want to take off risk, if you have this context here using that breakaway gap, you want to put that right above this fair value gap here. So I'm going to leave the stop loss here at the high, and we're going to play this out, and we're going to be looking for our first partial to be taken off at equilibrium, right? So we could take our high to our low, find that midpoint right here, and we're looking for our first partial to be taken inside of this fair value gap right here. This is your first targeting option, and you will not be trailing your stop loss. You're going to be leaving your stop loss above that high for the entirety of the trade. Now we've marked out our fair value gap resting at equilibrium. We're going to be waiting for price to move inside of that, which we get very quickly here, and we could take one off. At this point, I am comfortable trailing my stop loss above this bearish breaker and above this initial fair value gap that we just formed. Why is that? Because we displaced out of it and we formed an order block right here. So if price returns to this area, it should be a valid bearish order block and it should propel price in the other direction, right? So now we can trail our stop loss a little bit lower. Now we've taken off a significant amount of risk. The next spot we're looking for is that internal sell side liquidity at that initial reaccumulation phase right here. This is going to be our low-hanging fruit objective. This is our easiest sell-side objective to take out. So we're going to continue playing this out, and we take that out right here, right? And at this point, you could trail your stop to break even. Now, why are we trailing our stop loss to break even now? Well, that's because we have crossed over equilibrium on a closing basis. Not only have we crossed over equilibrium on a closing basis, we've taken out that first measure of internal sell-side liquidity. So what that means is we've had our first stage of distribution. Now we're anticipating a second stage redistribution, taking us down to our initial consolidation lows, right? That market maker sell model terminus price point. Because we have this narrative in mind, price should not return to this initial distribution point. At no point should price return back to first stage distribution. What we're looking at here is the SIBI we have formed and this order block we have formed. We're anticipating a move back into this fair value gap to displace us down to our initial consolidation lows. And just like that, we have a perfectly played market maker model here, right? And what we're doing is we're taking that 2022 model, and that is simply an entry strategy and a shell of a model, right? So that's just picking apart a piece of a model. And now we're taking that 22 model and we're adding in narrative, context. We know why price should do what it does. We know when it should do what it does. We know where it should go, where it shouldn't go, where it could turn around, and where it should not turn around. So now we can leave market replay mode. And that pretty much wraps up this advanced 2022 model lecture. All we did is we just added on to what we already know about the 2022 model. We gave it more context. With more context, you can make better educated decisions as to what to do with your risk in the marketplace. If you didn't grasp everything the first time, I would recommend going back a second time just to go over and take some notes, right? First time's a nice introduction. Second time, you want to dial in and take some notes. If you didn't understand a lot of what I was saying here, I do have an advanced market maker lecture on my channel. If that's not what you want to be looking at, just go down some simple market maker series videos on ICT's channel, right? He has a whole playlist of them. If you want to look at more advanced lectures from ICT, that's going to be his charter content, Model 6 and Model 7, surrounding the market maker model. And as always, until next time, stay safe.